Oh, there we are. Evening, ladies and gents. Simon Brown here doing this evening's Power Hour. Apologies for the slight late start. Sometimes things don't go quite as planned. We're talking about building resilient portfolios this evening. I'm going to go through all the crises, I suppose, that are happening out there in markets. Most recently, of course, was yesterday, US inflation 9.1%. And then what do I mean by resilient portfolio? But also, at some point, this crises will move behind us and we don't want to get left behind. So we don't want to be just resilient. We want that blend of it. If you've got questions, you can drop them into the Q&A box. We've certainly got some time for questions. I will probably get to them at the end because I'm managing all the stuff at one go. So we'll get to those questions at the end, but we've got time for the questions. Before we start the virtual trading game, Ross Spears from the JSE asked me to put a shout out for this virtual trading game.jse.coza. This is a live trading game, like the schools challenge, for those of you who may know that, with cash prizes and the like. But it's also a platform where you can go and sign up and try your hand at maybe a trading strategy, maybe a resilient portfolio. So go and have a look at that. You can sign up there and get going. And of course, into future competitions where, as I say, cash prizes. In the past, it was the students game, there was the schools challenge. Now we've got one for, well, I was going to say for the adults, not quite fair, the one for the rest of us. Let's get on to this evening. So there's data coming left, right, and center, and it all just looks fairly ugly. This is the QQQ, which is a New York ETF that tracks the NASDAQ. These charts will be a day out of date. Because of course, it's live right now, so markets are trading. And what we can see, having peaked sort of November last year, kind of rallied back to those levels in January, it's pretty much been selling. We've had a few bounces here and there, but this is not a good looking index by any stretch. And I did a presentation yesterday evening focusing for traders as distinct from investors. You'll find it justonelap.com. And when I look at this chart, it tells me one thing: you want to be short of this. You do not want to be long here. But we're focusing trading today, so that'll be investing. This is the Vanguard S&P 500, not looking much better. It peaked a little bit later in so the last trading day of last year, first trading day of this year, but again been going lower. And what you see is just a constant stream, occasional higher highs, but your highs are lower, your lows are lower. This is a market trending down. Where we sit is looking at US markets. We've got S&P down a little over 20%, NASDAQ a little over 30% down. That puts them both firmly in bear markets. And we've got our local market. In fact, if I take today's into it, probably about 14% down. So technically, JSE not yet in a bear market, but most other global indices are very much in bear market territory. This is our top 40. To me, the range is 59 to 62,000. That is it's sort of moving around. Today, we were at the bottom end of that, which suggests to me that probably, unless it holds, unless we get a nice strong bounce tomorrow, Friday, we can expect more weakness coming through here. We did, you will note, peak later in the process, and that was quite simply because at the beginning of the year, commodities were still strong. And that was saving us. The problem we have now is that commodities have even left the party, and that's left us in, I suppose we could say politely, a spot of bother. US inflation, this is going as far back as I can get data. So we're going all the way back into the 1920s. And we are, that print of 9.1 yesterday, we are firmly back in what they were seeing in the sort of late 70s and early 80s. Are we going to get to 15% and breach that? I don't think so. The thing with the US inflation, and expend a moment here because it's an important data point to understand. There are a couple of things. The talk of a year ago of transitory, well, it's just off. The transitory has fundamentally passed. It's here. It's absolutely happening. Is the Fed behind the curve? Yes, and we'll touch on them on the next slide, so we'll park them for the moment. A lot of this is driven by things that are not going to be impacted by interest rates and the like. It's energy, it's fertilizer costs, etc., etc. But inflation is in part expectation. A 9% inflation, you go into your boss's office and negotiate salary increases for the next year. You want 9%. You absolutely do. You're probably not going to get it, but you're going to get, and if you walk out with 7, 7.5, you feel hard done by, but that's inflationary, particularly as it starts to come down. And what I mean by starts to come down is some of this, and let's take, for example, oil. The oil price to the end of June, which was the 9.1 inflation print, that oil price was up, let's say it had doubled over the previous year. In other words, oil has to double again to get to the point. And is that likely to happen? I mean, is $200 oil possible? Sure. Is it likely? I just don't know. But what I mean is that it's that base effect. The base effect is now solidly in, so we'll probably see inflation starting to peak. I don't know, maybe Q4 this year. I don't think we're going to get back to the Federal Reserve's target of 2% anytime soon, but certainly the sense coming out of the Federal Reserve is that once they get to around the 4%, they're probably going to be comfortable. Not happy, but certainly comfortable with that process. So inflation is very real. And the thing with inflation, fundamentally different to unemployment. Unemployment in the US remains strong. That Friday jobs number was a spectacular number, unemployment rate 3.6%. But let's say unemployment goes to 10%. It ratchets up to that. You might still be having a dinner with family and friends and not know anyone in that group who is unemployed, even at a 10% unemployment rate. But with inflation, everybody feels it. From the poorest person living on the streets of Seattle through to Elon Musk and Jeff Bezos as the two richest people in the world and in America. Inflation touches everybody, and it spooks people. And we've had, 20, 30 years in the US of pretty much no inflation. And this is completely new, not just to the consumer on the street, but also to investors. As someone who's investing, this whole idea of investing in a high interest rate, rising high interest rate environment and a high inflation environment is new. And it does mean we need to revisit. And that's what I'm going to be talking about this evening. There is the Federal Reserve funds rate, equivalent of their repo. They have another meeting. It's 2 weeks yesterday, 27th of July. They will have another update. Initially, expectation was they were going to do 0.75%. Now the forward markets are saying there's now more than a 40% chance of a full 1% increase. And in fact, Citi came out earlier today, this morning their time, this afternoon our time, and said that they fully expect a 1% increase in 2 weeks' time. One of the voting members at the Fed in a speech a couple of hours ago was saying, yep, she's all on board for 75-point raise, but is happy to discuss a full 1%. Let's put that in perspective. The last 75-point raise that we had in the US was June. Before that was 1994. Inflation was about 5%. The last 1% rate increase that we saw in the US was in the 1980s, early 80s, 40 years ago. And that's what I mean where, and I hate the phrase, but this is unprecedented times. It will pass. I mean, what's different this time to the pandemic crisis of 2020 is that, in the pandemic crisis of 2020, it wasn't a market crisis, it was a health crisis. And yes, it was scary, and yes, we weren't sure how it was going to play out. The market was responding to events. If we go back to the 2008 crisis, I mean, that was just a derivative housing bubble that had got completely out of control. And in truth, a lot of the products being sold weren't what they were said on the sticker. This is different. This is just good old-fashioned economics. I mean, where did the inflation come from? Well, we've had quantitative easing in one form or another since 2008, both in the US, Europe, UK, and in Japan, although Japan goes way back further than that. We'd had that loose monetary policy coming through. The response to a pandemic was both fiscal and monetary. In that, the Federal Reserve cut rates and was buying back bonds, but the US government was sending out checks, $600 a pop, which, let's be clear, that's close to 10,000 ZAR. And that just pushed money into the system. What we also saw was saving rates spiked because we couldn't spend the money, you were in lockdown. And then what also then started to happen was that obviously demand disappeared. So production, supply then disappeared with it, in part because the demand had disappeared, but in part because, well, the producers of widgets and cars and everything else, well, they were also having a pandemic and struggling with staff and supply chains and everything. So we had this sort of gridlock grinding to a halt of supply, and that was fine because there wasn't demand. But now we're out. Now that demand is back, and it's back with a vengeance. 2 years of lockdown, people want to go on holiday, they want to buy things, they want to upgrade their motor car, they've got some savings and the like, and that wall of spending hit a supply constraint, which is improving, but still not quite perfect, and hence we have inflation. So a lot of it is beyond the traditional inflation that we see, although inflation's never, there's always a core reason for it. In the 70s it was oil more than anything else, and I appreciate that. But this is kind of economic, and it'll work its way out. I don't think that we're in a scenario where in 5 years, 10 years, we're looking back at 9.1 and thinking, yo, wouldn't that be great? I don't think we're in a scenario where we hit those 15% of the late 70s and early 80s. I do think there's a chance that we get back to those sort of pre-crisis 2008 crisis interest rates of close to 5%. And again, as Americans, not us, but the Americans, of course, that's something you haven't seen in well over a decade. So it's going to be difficult and tricky for a while. And what I mean by a while, probably through to the end of next year at an economic perspective. Markets, however, of course, are forward looking. But there's an important point here where, and I said it earlier, is the US inflation going to get back to 2% anytime soon? No, maybe 4%, but 2%, not anytime soon. It'll get there, but not anytime soon. So we've got to learn to live where the US inflation has been floating around 1, maybe 1.5, occasionally getting a little bit close to 2%. Suddenly you've got to look at levels at 4%, and that has implications. It means interest rates will rise, and then they will start to come down. Probably in about a year's time, they'll start to come down. Certainly, they'll probably stop rising by then, and the talk will be, when do we start to see our next interest rate cut? But again, are we going back to 0? No. Are we going back to 1%, 2%? Probably not. So it's that new reality which comes into it. And this is implications. One of the simplest ones, professional valuers will value a company using DCF and the like, and it's always the future value of cash, right? And a big component of that is the interest rate. And as the interest rate increases, that future value of, as interest rates and inflation increases, that future value of cash decreases, and therefore the valuation on a company decreases, just from a perfectly sort of linear process. And I appreciate markets and valuations are not linear, but you get the sense of what I'm talking about in that respect. This is the commodity index. It was having a really good period. It was running really, really strong, and it has pulled back quite markedly. And this is quite simple, because the other thing, which I haven't yet touched on, is the R word, recession. Now, the US already has a Q1 negative GDP. If Q2 comes in negative, they are technically in a recession. And even if it doesn't come in negative, GDP around the world has been downgraded. We had EU GDP downgraded today as well. And even without a recession, it is tough out there. People aren't spending. We saw credit card or unsecured credit in the US. Essentially, that's credit card. From the March to April number, and that's the latest data we've got. From March to April, it went up 20%. It's a giant, giant number, and shows you how much stress, pressure consumers are under. And if consumers are under pressure, it means growth is down, which means demand for commodities is down. A lot of the commodity story was around the infrastructure spend post the pandemic. Governments the world over, the US wants to spend $1 trillion, etc., on infrastructure. Does all of that trillion happen? Probably not. I mean, it probably never was, but now it almost certainly doesn't. And of course, there's China. They've had some more COVID cases over the weekend. Do they go back into hard lockdown? Second largest economy in the world. So it's that demand that is disappearing from the commodity space. That said, I don't see commodities collapsing in a heap. And that's quite simply because what we haven't seen over the last decade is new mines coming on, new production, new supply coming in. You're still digging into the same holes, and at some point those holes fill out. Now, normally a miner is mining here and digging and taking out the commodity, be what it may, and then over on this side, they're building new mines so that when this runs out, they've got new capacity. We don't have these new mines. That is the big issue. There's some of them, but on a global scale, the short answer is we simply don't have those new mines coming through. And that is critically important. And that, more than anything, is the bull case for commodities. And I stress, you look at commodities, it don't look very bullish whatsoever. And that's happened across the board. This is Brent. Popped above 100 again this morning, and then weaker again this afternoon. By all accounts, Brent is probably overpriced, except for two things. One is, again, the production. You know, back in a decade ago, one of the ways that oil price was kept in line was from the frackers down in the south of the USA. As oil rose, they would open up rigs, and they could get a rig running in 3 months, maybe 6. But that industry, firstly, they've taken out the easy, cheap oil, and now it's the harder, more expensive. At $100, that's fine. There's a bigger story, is that 8 years ago, oil price collapsing, lasted about 4 years. So you've got 3 rigs, and you shut down one of them, and you stick it in a storeroom, in a warehouse or something. And then when you need parts for the functioning ones, you don't go buy parts, you go and cannibalize the one that's sitting in a warehouse. You had staff that you laid off that in the olden days would hang around and say, well, you laid me off, but in 3 months or so, you'll be opening a new rig and have a job for me. And the 3 months became 6, 9, 12, 24, and those folks moved on, both literally to different locations, but to different careers, different job paths, different parts of the country. So now when you want to reopen, you haven't got your spare rig, you haven't got the staff. So you go to the supplier of the rig and say, please supplier, can I have a new rig or the parts? And the suppliers had the same problem. They've had a compression of sales because, well, you weren't buying, so they've cut back, and there's now a giant queue. So you can't get those rigs going as quick. So instead of 3, maybe 6 months, in some cases it's 12, maybe 24. Ditto story for OPEC. Of course, big part of OPEC Plus is Russia, second biggest producer. Patently, the world is still buying Russian oil. I mean, that we know. $100. The world is absolutely still buying Russian oil. Russia is happy for that. They want the money. It funds their war. Does the world at some point stop buying Russian oil? A lot of talk out of the EU about that, planning to stop pipe-bound Russian oil by the end of the year, some carve-outs for Hungary. I'm not sure that that's necessarily going to happen. We will see how that plays. Oil demand for next year is expected to be slightly above 2022, which of course was markedly above 21 and 2020. But if we've got tough economy and the like, is that really going to happen? And we'll see in time. But yeah, this is probably the commodity I'm most bullish on. And even I'm looking at it and thinking that is not a pretty chart. Here's gold, which is the one that's completely flummoxing, right? Gold's the safe haven, right? It's designed for inflation. It's a store of value. Except here we sit and gold is not even close. Sure, it's 2x what it was back when inflation was 15% in the US, but inflation adjusted, it's lost value over the last 40 years or so. This is definitely a support zone for gold, but gold is just not winning, not at all. It just isn't, the trick is, uncertain times. When things are good, what do people want? A return on their money. In uncertain times, they want a return of their money. Where's the best place to get a return of your money? Well, US Treasuries. Hence, strong dollar. People are buying the dollar because that's a safe haven. And then once they've got the dollar, they stick the money into Treasuries. Gold, you can lose money in gold. If you buy a Treasury, a 10-year at 2.5%, can you lose money on it? Sure. But if you hold it to maturity, you're going to get your 2.5% a year. You're getting slaughtered, right? Because inflation's 9, but it's better than gold, which who knows? Maybe you bought it at 2050 and now it's 1727. This is the US dollar index. It is the strongest it's been in 20 years. We have the euro at parity with the dollar for the first time in 20 years. We're seeing massive dollar strength. And the reason for the massive dollar strength was just as I'd explained. So we had started to see that already in 2015. It had moved along, but it was kind of moving sideways. But since about the middle of last year, it's been moving higher. And that is that flight to US dollars. This dollar strength is not just against emerging market currencies, such as our own. It's also against developed market currencies, such as the euro, such as the pound. We're just seeing dollar strength. This will turn fairly quickly when we start getting some certainty back and some, not certainty, because markets never give certainty, but less concern. When the recession word is completely banished, when inflation is starting to come down, when the Fed starts doing, 50 or 25 basis point increases, or maybe nothing, they skip a meeting and skip the meeting, but they don't do the increase in that meeting. They say, don't worry, we're good to go. And at one point, the Rand was actually not doing so badly against the dollar up until 16 days ago. And what happened 16 days ago? Andre de Ritter and Eskom talked about stage 6, and a couple of hours later it happened. The Rand was 15.80, today 17.30. So it is suddenly caught up with it, but that is, because of the load shedding. And why is our Rand being stronger? Well, commodities are priced in dollars. So a South African mining company pulls the commodity out the ground, sells it in dollars, and then converts that into ZAR. So there's demand for ZAR, hence we had been relatively strong. As I said, the last decade up until beginning of this year, but the 10 years ahead of that, investing was kind of easy. Tech was flying. How did you make money? Bought a tech stock, a high-flying tech stock. And there are too many to mention. You bought almost any one of them and you did really well. Heck, you just bought the NASDAQ. I mean, this is the NASDAQ. You could have just bought the ETF at 2,000 and it peaked out at 16,000. That is an 8x return in a decade. 800% in a decade. When you think that the long-term return for US equities is 8% a year, which means in a decade, you're doubling your money, a little over. You'll come out in a decade about 120, 130%. I'm doing the math in my head, so I'm slightly out. Don't bust me for it. And you got 800. That couldn't last forever. And I think this is the biggest point. And this is more than anything why this presentation this evening. There's a lot of people, and you know what? I'm not taking anything away from you. If you bought this index or if you bought some of those stocks and you've made lots of moolah over the last decade, kudos to you. You deserve every cent of it. But I don't think the next decade is going to be as easy, particularly for tech. And I'm going to come into a lot more detail on tech in a moment, but I think it's going to be a lot tougher for tech, and it's going to be a lot tougher for investors to find, what is that next 800% return in a decade? I don't think there is one in the next decade. Someone's saying, is it crypto? Crypto is just a risk asset. Basically, crypto will track the S&P 500. If I'm short the S&P 500, which is I think is the preferred trade right now, either you're short or you're flat. Then you want to be short crypto. Crypto is not any of the things it promised us. It's not a store of value. It's not a hedge against inflation. It's a leveraged risk asset, which is essentially leveraged on the S&P. So now it is tough. Inflation will come down, base effect. Rates will start to come down. Second half of next year, maybe early 2024. But that free, easy quantitative easing money, it's gone. The zero rates, gone. 1% US inflation, those are gone. Will we get quantitative easing back? I hope not, because if we do, it means there's a big problem out there. Will we get zero rates back? No. Again, I hope not, because if we do, there's a problem out there. Will we get 1% inflation again in the US? Sure. But when? Next year? No. The next 10 years? Yes, but not in a hurry. So that's the thing, is it's a different market now and looking forward than it was over that last decade. And hence, resilient portfolios that are positioned to not just catch the resilience of companies that can offer it to you, but also give you that option so that if something does do 8x in a decade, you're on board for it. So let's delve into it. The first, of course, is diversification. The only free lunch, as Warren Buffett says, across industries, across currencies, sectors, the same old story with diversification. But be very careful with the over-diversifying. Keith McLaughlin makes a great point, which he said to me a couple of times. He says, okay, so diversification is great. So you say to yourself, I want the 10 best shares on the JSE. I don't mind what they are. I just want the 10 best stocks. So you go and find the best stock and you buy it. And then you buy the second best stock, and the third and the fourth and the fifth. But by the time you're buying the 10th stock, you're now buying the 10th best stock on the JSE, which means you've gone from the best company to the 10th best, and you're actually, diversification is actually, as much as it's diversifying, which is a good thing, it's also bringing in risk. In other words, don't over diversify, and don't leave out the laggers. Don't look at something like, I don't know, whatever, a Pepcore and say, oh, it's been boring. Yeah, maybe it is. But maybe this is a time for some boring in our portfolio if the go-go tech is going to be having a tough time. So portfolio, and many of you have seen me present before, would have seen me present a chart very similar to this. You've got ETFs, cash, near cash sitting down at the bottom. Those can be in defensive, they can be in your techs, etc. You split that out. You've got a wedge of resilient stocks running through the middle. I call them my death to us part portfolio. And at the top, you've got your spice. And that would be perhaps some individual tech stocks. That would be, maybe if you want to stick some crypto in and the like. But have that base and have that resilience in the core. And keep some spice there so that, if things run, if I'm wrong, if certain sectors suddenly have great periods, then you're in exactly the right space for it. So what are resilient stocks and how do we find them? Cash flow. Cash remains king. Uber, the new CEO of Uber, sent out a memo, I think it was back in April. And he said, quite simply, he said, there's only one thing that matters right now, cash. Are we generating free cash flow? There's nothing else matters. Total addressable market, not important. Dominance in a market, not important. Market share, not important. Are we generating free cash flow? And do we looking at each market that they're operating in, is that market generating free cash flow? If not, get out. And that conversation has been had by CEOs all over the place. Let's look at Netflix. Huge numbers of subscribers, hugely profitable in terms of revenue and EBITDA, but huge expense in terms of production and making new things for us to watch, but not cash flow, not free cash flow positive. And what they're now doing is talking about bringing in ad tiering. Why? Cash flow. The people share Netflix accounts, and they're starting to clamp down on that. And by the end of the year, they're going to get quite very strict around the sharing of Netflix accounts. Want that cash flow, but more than just cash flow, want strong and consistent cash flow, not lumpy, not Netflix doing some creative business and suddenly they get a positive cash flow quarter and then it's all over. And we're going to see a lot. There is earnings season starting tonight in the US, starting with the banks. But a lot of companies at the previous earnings seasons back in April, when they were reporting the Q1 for 2022, they didn't have very great numbers. And they said, don't worry, we'll come back in a quarter, we'll have the great numbers. And I'm thinking in particular, for example, Netflix. I'm thinking in particular, Facebook. When Facebook had their Q1 numbers and the stock crashed to 240, I remember at the time I did a JSE Direct podcast and I said, this stock is still overpriced. Now it's about 160. We'll see results in the next couple of weeks. I think it is still overpriced. So they've really got to pull rabbits out the hat. And I'm not sure they got any rabbits or very much hat in these earnings. Expectation is for growth of about 4.1%, which at best can be described as modest, but we'll see. And if they come in at 4.1, it'll broadly be okay. If we miss that, we're in bigger trouble. So cash flow, but strong and consistent cash flow. And the easiest way to see this is to go look at dividends, not dividend yield, but look at those dividend payments. Now, is there a long track record of dividends? Does it consistently go up every year? Probably not by a heck of a lot, but do you have that? Do they have pricing power? Particularly in a time like this. So Netflix had some pricing power. They did some price increases. And in South Africa, they did that price increase and pushed the top tier up to $200. But do they still have pricing power? No, because Disney's here. We've got Showmax. We've got Amazon Prime, and Amazon is coming full steam into South Africa in the first quarter of next year. They don't have that pricing power. So companies that can raise prices even in tough times. And these are consumer staples. Yes, if you're a toothpaste and you push the price up, you might lose a couple of customers to a cheaper brand or a no-name brand or something like that. You can kind of hold on. If you're ShopRite and you're pushing prices higher, you've absolutely got the power there, right? Because we need to eat. And ShopRite, is really good at squeezing the supplier way more than the customer. And do you have a moat? Do you have something that says the customer needs your product and not a competitive product? What's Apple's moat? Apple's moat, for example, is delight in the product. Nice, but I can go spend 35 grand in an iPhone, or I can go spend 1,500 in a Mobicel. broadly, they do the same. I know the iPhone's going to be better. Yes. And you can get a 10 grand iPhone. Yes. But is that a moat for tough times? No. Netflix's moat? Nothing. ShopRite's moat is customer loyalty and the fact that they manage prices. And I'm going to come to more of that in a moment. So what you're looking for is cash flow, strong, consistent, long track record. You're looking for pricing power. Can they raise prices? Because they are seeing input costs rising. So this isn't about them wanting to increase margins or make more profit. This is about the company saying, you know what, our input costs are going up. Can we pass this on? And do you have a moat? Do you have a moat against current competition and perhaps new competition that comes on? And those are the three. If you can tick all three of those boxes, you've got resilient stocks. Now, usually we end a power hour with some stocks, but I'm going to do it right now, bang in the middle. The first, British American Tobacco. They pay quarterly sterling dividends. Their dividends are so predictable. In February, they announced the 4 payments for the entire year because they know more or less what their money is going to be. They have pricing power. How do we know this? Well, 2 ways. They've got different brands. So they've got their premium brands, which they charge more for. They've got their cheap brands. And every year, their prices go up because of extra tax, the sin tax. And usually, that tax is ahead of inflation. Does that see some people smoking less? Yes. The data absolutely says that raising taxes on cigarettes cuts out some smokers. Some shop down, some just move out. But does it do it markedly? Does it destroy an industry? No, it doesn't. Is it defensive? Sure. Smokers are smokers. I'm one, so I know the story. I mean, I'm not proud about it, but it is true. I smoke and I know that it is defensive. So a company like British American Tobacco, which is deeply boring, and you will note if you go have a look at the chart, it's actually had a fairly good 2022 compared to everybody else. Why? Because people are liking defensive stocks right now. They like these quarterly dividends. So they're paid in sterling, of course, converted into ZAR. We receive it in rands in our JSE account. They like that the fact that it has some pricing power across brands as well as within brands, and that it is ultimately a very defensive company. New customers coming in, not so much. Existing customers dying, yes. There will come a time when planet Earth will look out at smoking as a concept and think, what, like the second craziest thing you ever saw. Craziest thing was digging stuff out of the ground and burning it, but this will be the second craziest. ShopRite, I hold ShopRite. Good cash flows from ShopRite. They had a wobble, was it 2018, 2019, a bit of a wobble on that, but they've sorted it out. The thing with food retailers is you're always going to be eating. Now you're going to say to yourself, yeah, but I'm going to Checkers is expensive. It's going to lose. But people are shopping down in the bad times, and people are shopping up in the good times. So now people shop down from Checkers to ShopRite to USave, and in the good times they shop up from USave to ShopRite to Checkers, and maybe ultimately Woolies out there. So they've got that defensive nature. They've also got the trust of the consumer. And that is so incredibly important. And what I mean by this is that the consumer knows that ShopRite as a group has their interests at heart. And the best way of doing this is I go to a Checkers sometimes in Emirates to do my shopping, and they do you a 35 Rand lunch. It's a coffee and a chicken wrap for 35 Rand. I've never had one. I don't know if it's any good, but folks, for people who are struggling and trying, making ends meet is hard, they see that and they see, that's a good price. And of course, the Checkers is for the rich folks. You go to their lower income, they do a 5 Rand lunch for the blue collar worker. And the blue collar worker knows, because the blue collar worker is smart. They know that they can't make that lunch for 5 Rand. And they get that loyalty. And they do it, this isn't trickery. They really are selling a 5 Rand lunch. They really are doing a 35 Rand coffee and a wrap at their upmarket stores. Upmarket relative, but you get the point. And they build that trust. And that is hugely important. Now, you could switch to Pick and Pay or Boxer or Woolies or whatever the case may be. Choppies, if you live in a place where there is. Spar, there are other options out there. But ShopRite has proved over the decades, and there's a risk one day they get it wrong, but they've proved it over the decades. And then the innovation such as the Extra Shopper, the Checkers 60/60, and I don't need to to wax lyrical about Checkers 60/60. They are deeply defensive. The share price is actually surprisingly volatile considering its defensiveness. But the reason for the volatility is because it's regarded in such high regard by investors that they keep on pushing it to crazy levels. And then at some point, it comes back to sort of better, more attractive type levels. So strong, resilient, good cash flows going through, price being under pressure, some nice entry points coming in. Pepkor, another one. Pepkor's kind of the ShopRite for non-food, multiple different brands, budget brands as a rule. You know, there's a chap I know, a guy I help, a homeless person, and he needed a phone. And there was no doubt, I mean, he knew, he's like, oh no, I'll get one from Pep. He knows that that's where you go and get a cheap, you know, candy bar phone. It's not doing anything fancy, but he knows that's where he gets one from. Mothers know that this is where they do, you know, get school uniforms in January, if you're looking for value. Pep's got this again entrenched, mostly focused at lower LSMs. And again, in hard times, people shop down, end up at Pep. In good times, people shop up, end up at Pep. And there's more. There's Pep, there's Ackerman, there's their Pep Home, which has been a huge success. They've got their little delivery service, and I forget what it's called now, Pixcore, something like that. They do like 11,000 deliveries, parcels a day. And it's 11,000 people going into one of their stores every single day. Actually, it's 22,000, right? Because someone dropped it off, someone picked it up. I mean, staggering numbers, deeply defensive. This one, I've got some cheeky bids in it. It's on my watch list. 19 Rand is a nice price, but I think we might get a slightly better price in the head. And these are, you know, they're growing. Growth is tough because, you know, go to a shopping center and not find a ShopRite or a Pepkor brand. But you get the sense of where they positioned themselves and that resilient nature that they have. So those are three individual stocks. Let's look at some broader sectors. There's the S&P Global Dividend Aristocrat Blend Index. You know, these things have got ugly names. Sam Beck-Bessinger was commenting on that the other day. They really do. GLODIV is how you will find it on the JSE. To be included in this ETF, depending on which territory you're in, you need, in some cases, decades of consistent dividend payment. So it's companies like consumer staples, utilities, some financials, healthcare, some discretionary consumer, but fairly small, industrials. But the key point is that it's consumer staples, which are the top one. Now, is this going to, again, shoot the lights out? No, but this is, again, those boring defensive companies. How do we know they're boring and defensive? Because they meet the strong cash flow. And how do they meet that strong cash flow year in and year out over decades? With pricing power and with the moat. If they didn't have those two, pricing power and a moat, quite simply, they wouldn't be able to do consistently decades of dividends. You know, look at the likes of, you know, we could argue Vodacom. And Vodacom, to a degree, yes. Although it's certainly got cash, but it's got a lot of spend because there's always a new G coming out, 5G is coming, and folks are already talking about 6G, et cetera, et cetera. But their defensive nature always bothers me because, again, switching is so incredibly easy. MTN, no. I mean, MTN appointers can dividends. They've had some significant issues and had to completely pull dividends. So from the ETF space, GLODIV, it tracks offshore stocks in rands on the JSE. What about cash? The problem with cash is twofold. Tax, remember, interest above 23,800 if you're under 65, 34,500 if you're above 65. Any interest above that in a tax year is taxed, is added to your income, taxed accordingly. And even the before tax rate, are you beating inflation? But there's a place for cash, and there's a place for cash two ways. The one is just having cash to buy stuff when prices are what you like. The second is having cash for return. This is the RSA government retail bonds. You go Google them, you'll find the website. You can't buy these in the JSE. And you can get 5-year fixed at 10.5%. It's ahead of inflation. Depending, I mean, if you can do that and come in within your interest exemption, in other words, you're not paying any tax on that, that's not a bad return for the next 5 years. Is equities going to do better? Maybe, but maybe not. And you can lock in some solid returns. You can also do the inflation linked, where basically your capital increases every 6 months by CPI, and then they pay the 2.75%, 3 or 4% as the case may be. These rates reset every month. So there will be a new rate on the 1st of August. But if you've gone in beforehand, you get that 10.5 for the 5 years. You can withdraw early. In the first year, you need a really good story. After the first year, you can withdraw, but any accrued and unpaid interest is forfeited. And if the rate is suddenly 12%, you can reset to the higher rate, but you've also got to reset the duration. So there's actually a bit of flexibility here. Your risk is SA government doesn't pay, but they're not going to default, right? They own the printing press. I know, inflation and all of that, etc. They're not going to default on these. And there's certainly a space for one of these. I picked up April 2020, dark days of the pandemic, 11.5%. I picked up some at that rate. Last year, 11.5% was not a great return. This year, 11.5%. I mean, our equity market is down over 10. Let's say it goes sideways the rest of the year. You've outperformed 20% on equity with cash. So what about inflation? What wins in an inflation environment? Two things tend to win in inflation. The first is generally resources, because they're priced in dollars. We're seeing a strong dollar. Resources tend to do fairly well. The problem is that when that inflation then starts to raise fears around recessions and demand, and we've still got COVID worries and lockdowns in China, that can really throw the wheels off their entire equation. I'm long resources, some individual mines and a few of the individual commodities. Resources is a hard call from this point. I'm still holding. I got some Satrix Resis. I picked them up around the middle of last year or so. I've got some I picked up way before that, and I'm comfortable with them. But I'm keeping an eye on it. Because where does this go from here? If things get really ugly and we start to see recessions in developed economies, and China starts doing more hard lockdowns because of COVID, commodities are under pressure. They're absolutely under threat. And then listed property, not office. I'll get to office in a second. Listed property, because oftentimes the increases are inflation linked. So you've got the offshore ones, the GL prop from Core Shares. Signia's got one as well. I think it's SYGP is the one from Signia, which tracks the 50 biggest property companies globally. They're dollar-denominated companies, but you buy them in ZAR on the JSE. I like the Core Shares prop. This is it's local property, and essentially it uses the yield as a weighting factor. In other words, the better your yield, the more weight you have in that particular index. The trick with these, and I hold some CS prop, I'm quite comfortable with that. The trick with these, of course, is stay away from office. Castle with a K is an American company who track office occupancies in the US. So they track fun activities, airports, restaurants, and baseball or basketball games, and they're pretty much back at 100%. And they track office occupancies, currently at about 45% of where they were pre-pandemic. Yes, people are starting to go back to the office. Yes, more will go back to the office over the next 6, 12, 18 months. Are we going back to 100% where we were pre-pandemic for office? No. In a time such as now, is office under extra pressure because companies are struggling, companies are going bust, companies are downsizing? Yes. So if you're buying an ETF, some office is fine, you can't avoid it. But if you're buying individual stocks, stays away from office is my view there. High growth, aka tech. Talked a bit about tech. I mean, don't abandon tech. But I think growth is going to be under pressure. It will come back in time. I think there's some stocks. Netflix was what, $750? That was truthfully ridiculous. At $175, I don't think that's cheap yet. I don't think Facebook at 160 is cheap yet either. I think tech's got more downside to it. Partly because, in the last decade, getting money from venture capital was just the easiest thing in the world. And raising money for tech startups was just, I know stories and of tech startups who wanted a couple of $1 million, and in fact, even in some cases, South African ones. Tech startup in Cape Town, a small little team doing a product for customers, got €1 million with basically one 3-page term sheet that they send through to an investor in Europe. Those days are gone, and a lot of the valuations were crazy stretched. Netflix at 750 was just madness. I mean, even Tesla, which is as much a tech company as it is a motor company, Tesla at 1250 was a ridiculous. It was more valuable than the rest of the industry. That just makes no sense. A lot of this tech went far too far. However, some companies, Microsoft as an example, Microsoft is down markedly this year, but is the Microsoft of July 2022 any different to the Microsoft of January 2022? Sure, they might lose some customers on their Azure side. Sure, they might have a few less Xbox 5 because consumers under pressure. A couple of folks might keep on their current console and not upgrade. Absolutely. But markedly, is Microsoft in fundamental trouble because of what's happening out there in the world? No. So your tech, you can do the ETF, the NASDAQ ETF. I think it's going to be painful for a while yet. I think we've got some more downside there, so I wouldn't rush into that. But I think there's some quality there at a price. And I think some of those prices are worth having. And maybe you're like, no, Simon, you don't understand. Tech is the future. Okay, sure. This is your spice, right? Because tech is the future. I don't dispute that. I'm just saying that the decade ahead is different from the decade behind. And tech is not going to do 800% in the next 10 years. So you want some tech, but you want it to be a part of a portfolio, not a portfolio. So to the end, I mean, truthfully, we should always have resilient portfolios. But of course, when things are flying and it's go-go and people are making vast amount of money on stocks we've never heard of and don't understand and etc., then suddenly we're like, yo, hang on, and we lose our discipline, perhaps is the phrase I'm looking for. Some boring stocks in your portfolio serve a purpose, particularly the dividend payers. Because what they do is they're generating you consistent dividends, and when markets are falling, you take that consistent dividend payment and you stick it into a cheaper market. Take your British American Tobacco dividend and buy Microsoft or the Satrix NASDAQ ETF or whatever the case may be. And that's the beauty of them. Leave some space for that spicy part. Part of this is that they're going to be, at some point, this presentation will be obsolete in the sense that the troubled times we're sitting in today will be well behind us, and there will be things we'll talk around the braai or the cup of coffee or something like that. We don't know when that's going to happen, but you want to be positioned for when it is, because otherwise it's a case of we're going to miss the bottom, we're going to miss some of it, and that's also fine. But keep some spice in that portfolio as well. Consider some near cash or bonds. I think there's definitely, I think there's always a place for that. Those retail bonds, again, so when they spit out the interest every 6 months, and if you're over 65, you can have monthly. I think it's quarterly, and if you're over 65, you can do monthly. You can have it reinvested. That's what I did. But again, there's an argument to say, well, pay that out to me, and let's go and buy some equity with it. In other words, use it to A, give your portfolio some resilience and a buffer, and B, to generate some cash to buy stuff when things are cheap, as they are right now. So it's about that focusing on long term. And that's what's so critically important. It comes back to this slide, which I had right up front in this evening's presentation. Down at your bottom, your ETS, your cash, your near cash. Your middle section is your resilience, and then there's some spicy at top. And I see the one question coming through, is shouldn't we age adapt this? Sure, the younger you are, the more spice you can throw in. The older you are, the less spice, the more cash that you stick down at the bottom. I mean, obviously, it's dependent on your risk profile and when you're going to be needing this portfolio for actual spending and money and the like. We'll leave it there. I got a couple of minutes for questions. I can see some more questions coming in, so let's jump to those. If you've got questions, drop them into the Q&A box. We certainly have time, so we can certainly do some. I just can't find it now. There it is. Peter, would you start dripping cash into the Satrix Resi now? I probably would. I'm not, because I have plenty. I probably would be taking small positions. You know what, with resources, and let's remember that markets are broadly cyclical and resources are very cyclical. They're having a tough time right now for all the reasons mentioned, recessions and China and all of that. We get that. But even if we don't have a recession, and if China does have some COVID worries and more hard lockdowns, let's roll to end of next year. The fundamental underpinning of the resource sort of support and rally is missing, and there's no new production coming on. So when no new supply, when demand comes back, there's still no new supply. And the companies, those resource companies at current levels, if commodity prices don't move, and I think some of them will move lower. I think PGMs are probably more or less in balance. I think some of the bulks and industrials, magnesium, iron ore, coal, are probably overpriced by maybe as much as 30 or 40% in some cases. But even at those lower levels, our mining companies are making money hand over fist. They're not going to make as much money as they did in the first half of 2021 when commodity prices were way higher, but they're still going to make good money. And remember, of course, weaker rand helps them because they turn dollars into ZAR, and it frankly looks better. So would I be buying some now? Personally, I have enough. They're going to give me seats on board soon. But if you are light on commodities, I think there's space for it in a resilient portfolio. Niyaz, would you recommend selling ETFs at a loss to pay down a home loan? Great question. There's a lot of T's and C's on here. Short answer is no, I wouldn't. Because your home loan is not bad debt, it's long-term debt. I know interest rates are rising. We've got an MPC meeting on Wednesday, Thursday. We'll get the announcement on Thursday of next week. So I'm looking for my drink. And it is edging up a bit. I think our interest rate cycle in South Africa is nearish the top, maybe another 1.5%. So the point is, if you are secure in your source of income, I'm assuming a salary, and you don't think that's disappearing, and you can handle another 1 or 1.5% increase in your home loan, I wouldn't be selling equities now, no. I would, but if you are worried about losing a job, if you are worried about being able to pay for the bond every month because of rising rates or personal financial circumstances, then sure, then it's a different game. But at this point, you don't want to be selling equities. Even if they go lower, even if we take another 20% lower on equities across the board, I can promise you that in 5 or 10 years' time, you're going to look at today's price and think, yo, that was a nice price. And here's a stat from Citadel. Who was I chatting to from Citadel earlier in the week? Can't remember. On my MoneyWeb podcast, George Herman. And he made the point that the data shows that median return, negative return in a bear market return or sell-off return in a recessionary environment is minus 33% on indices. In a non-recessionary, but in a sell-off is minus 11%. Markets are kind of in the middle. So markets don't know if we're recessionary or not. I said earlier, recession or not, does it matter? It's tough out there for the consumer. What I'm saying is there could be another leg down, and that another leg down could easily be 10, 15, 20%. So short answer, I wouldn't be rushing at this point to sell equities if you can possibly avoid it. But if you need that cash flow, then sure, give it a good decision. Peter, Exara versus Sibanye for the medium term. Between Exara, okay, I'm going to, so I hold Sibanye. Let's get that out of the way first. Disclaimer, I hold Sibanye. I like it. I like their assets. I like what they're doing in lithium. I like what they're doing in green metals, but those are longer term plays. I'm comfortable with PGMs where they are right now. They of course got a bit of gold, and everyone forgets they also own 51% of DRD. If we take it, do I want to be in the PGM/energy space, PGM space versus the old school energy? Right now, probably coal. Although I think Thungela Resources over Exara, although I haven't dug into Exara in a bit, but certainly Thungela. Thungela could pay 100 Rand dividend this year. That's a 40% yield. It's just ridiculous. Longer term, let's say, on the 5 to 10 year horizon, I would prefer Sibanye. So if I could say a coal miner in the shorter term and longer term, perhaps a PGM space there. Yeah, a question coming through around should you be selling? Should you be heading for the hills? No. If you've got time on your side, and if you're in the equity market, you should absolutely have time on your side. Then no, you should not be selling. The time to sell is at the peaks, not at the troughs. And we might not be absolutely at the trough, but we're close to that trough. Not a time to be selling right now. So no to the selling side. Around the RSA retail bonds, you buy them directly from RSA retail bonds. They used to have a tax-free offering. That no longer is offered, but you buy it directly from them. It's a bit of a clunky website, but it works, and you get your dividend payment or interest payments either reinvested or paid out to you. It works as it says on the sticker. And sometimes you go to the website and the website doesn't work because it's broken. Just come back tomorrow, it'll be fine, and don't stress. The website team is not the people who run in Treasury who pay the money every time. Ladies and gents, we're almost at time. I'm not seeing any further questions coming through, so I'm going to park it there for now. Apologies for the slight late start earlier. It was a minute or two, but I hate starting late. Sometimes things don't always go exactly to plan. I think the key point here is that what I'm really looking at in this presentation this evening was that there's going to be, I think, a fundamental difference to the next 10 years versus the previous. Let's just take the simple case that, as a rule, the long-term return on the S&P 500 is about 8% a year. Over the last decade, it's been closer to 18. So in simple math, we need to reverse to the mean, which means that for the next decade, there should be zero return. I'm not saying that, although that's also possible. The US has given zero return over a decade, the first decade of the century. But what I am saying is we're not going to get 18. We might not get zero, but we're not going to get 18% averaging for the next decade going forward. So we need to be more resilient. We need to be more clever. And some of those tech stocks, just because it was 750 and now it's 175, that doesn't mean it's cheap. It can still be ridiculously expensive. It just shows how much some of those higher valuations were based on absolute ridiculousness. Question coming through, but what about companies like Zoom? And that's a great point. Zoom, last time I checked, and I haven't looked at it in a bit, Zoom is trading below where it was pre-pandemic. And that is ludicrous. Because how many of you out there knew what Zoom was in December of 2019? I did, because my sister used it. I'd never used it. And I used to say to her, but why Zoom? Everyone uses GoToWebinar. Why are you using Zoom? And she was like, it's better. Well, I agree, it is better, but no one knew about it back then. They've signed up humongous new clients. Now, sure, a lot of people are no longer Zooming because we're going to work, because I did an in-person event today. We're going to have these power hours back. Maybe October, we'll be back at the JSE and virtual at the same time. But there's more of us using it than there was 2.5 years ago. So there are some places, and that's the argument to make with Microsoft. Some of these stocks are like, it's just making no sense. Absolutely. Ladies and gents, we'll park it there. Thank you very much for your time this evening. My name is Simon. As always, look after yourself, stay safe, and if you can, look after somebody else as well. Cheers all.